Welcome back to MONEYMORPH, where we break down complex economic concepts into understandable insights. Today, we are diving into a fundamental question that affects us all. Who decides the value of the dollar, the pound, or any other currency? And why does one US dollar called global currency? Let's explore the fascinating world of currency valuation. What is currency valuation? Currency valuation refers to determining the worth of one currency relative to another. This valuation is essential for international trade, investments, travel, and global financial stability. Currency value is determined like any other good or service in a market economy, through supply and demand. Factors affecting supply and demand are regulated by the government through monetary and fiscal policy. But who exactly sets these values? The value of a currency is not set by a single entity but is influenced by a combination of market forces, government policies, and global economic conditions. History of currency value. Currency came around several hundreds of years ago as a means to replace the barter system. Early currencies were commodity money, meaning they derived intrinsic value from the precious metals they were made of. However, the impracticality of commodity money created the shift towards representative money, money that lacks intrinsic value but is backed by its ability to be traded for a physical commodity. The most notable use of representative money is under the gold standard, where each country's currency is tied to a fixed amount of gold. The drawbacks of the gold standard became clear during World War I. The gold standard left little room to adjust the money supply because new money could only be issued with a new supply of gold. In the wake of the government deficits during the war, many countries were forced to abandon the rigid gold standard to print money freely. Following World War II and the Vietnam War, representative money was officially abandoned globally in 1971. The end of representative money ushered in our current form of currency, fiat money. Fiat money does not possess intrinsic value nor is it backed by commodities. Rather, its value is determined by supply and demand, backed by the creditworthiness of the issuing government. It eases the severity of crises compared to under-representative money because the government is able to print more currency. The role of supply and demand. Asterisk, scene, animated graph showing supply and demand curves for currencies. On a fundamental level, currency value is determined by supply and demand, both domestic and foreign. Increased demand appreciates the currency value, while increased supply decreases the currency value. Many factors may affect currency value, such as 1. Interest rates. Currencies of countries offering higher interest rates tend to increase in value, all else being equal. This is because fixed income investors flock to higher interest rates, which increases the currency's demand and value. 2. Inflation. High inflation erodes the purchasing power of the currency holder and increases the cost of local goods. Countries that experience higher inflation may experience a decrease in currency demand, and therefore a depreciation in currency value. 3. Capital flow. Capital flow represents a large portion of the demand for currency. Large amounts of capital inflow going into a country appreciate the currency, while capital outflow depreciates the currency. 4. Money supply. Money supply refers to the money within a country at a given point in time. The higher the money supply, the lower the currency value and vice versa. Measuring currency value, exchange rates. The most common way to measure currency value is by measuring its convertibility to other currencies, also known as the exchange rate. Since the end of the gold standard in 1971, the majority of the world's currency has adopted one of two exchange rate systems. 1. Fixed exchange rate. A fixed exchange rate is when one country pegs its currency to an anchor currency so that both currencies move identically. Countries that opt for a fixed exchange rate are usually developing countries seeking currency stability. The most common anchor currency is the US dollar since it is relatively stable and considered a safe haven in crises. The downside is that countries with a fixed exchange rate give up their policy independence and suffer from lower free trade and liquidity. 2. Floating exchange rate. A floating exchange rate involves letting the foreign exchange market determine currency value with respect to the supply and demand of other currencies. Countries under a floating rate system may experience higher exchange rate volatility but also benefit from exercising more autonomy over their economic policies and trade activities and enjoy higher liquidity. The government usually still intervenes occasionally to keep the exchange rate within a reasonable fluctuation band. Institutions like the Federal Reserve in the US, the European Central Bank, and the Reserve Bank of India manage their country's monetary policy, which includes setting interest rates and controlling money supply. Central banks and monetary policy. Images of central banks such as the Federal Reserve, European Central Bank, and Reserve Bank of India. Central banks play a crucial role in influencing currency values. Institutions like the Federal Reserve in the US, the European Central Bank, and the Reserve Bank of India manage their country's monetary policy, which includes setting interest rates and controlling money supply. When a central bank raises interest rates, it often leads to an appreciation of that country's currency, because higher interest rates offer better returns on investments denominated in that currency. Conversely, lowering interest rates can lead to depreciation. Economic indicators and market sentiment. Charts displaying economic indicators such as GDP growth rates, inflation, and unemployment rates. Various economic indicators significantly impact currency values. These include GDP growth rates, inflation, employment data, and trade balances. Positive economic data can strengthen a currency, while negative data can weaken it. Market sentiment, or how investors feel about the economic outlook, also plays a critical role. Political stability, economic forecasts, and even geopolitical events can cause significant fluctuations in currency values. Government intervention. Footage of government officials and policy announcements. Governments can directly intervene in the currency markets to stabilize or adjust their currency's value. This is often done through buying or selling currencies in the foreign exchange market or adjusting their fiscal policies. For example, China has been known to intervene in the yuan's value to maintain its export competitiveness. Purchasing power parity, PPP. Illustration of the Big Mac Index or other PPP concept. Purchasing power parity is an economic theory that compares different countries' currencies through a basket of goods approach. Essentially, it suggests that in the long run, exchange rates should move towards the rate that would equalize the prices of an identical basket of goods and services in any two countries. For instance, if a burger costs $5 in the US and the same burger costs 250 rupees in India, the PPP exchange rate would be 1 United States dollar equals 50 Indian rupees. Case study: USD to INR exchange rate. Historical chart showing the USD to INR exchange rate over time. Let's take a closer look at the USD to INR exchange rate. Several factors influence this exchange rate, including 1. Interest rate differentials. Differences in interest rates between the US and India can attract investors to one currency over the other. 2. Inflation rates. Higher inflation in India compared to the US can devalue the rupee. 3. Trade balance. A trade deficit in India means more demand for foreign currency, affecting the INR's value. 4. Foreign investment. High levels of foreign direct investment, FDI, in India can strengthen the INR. 5. Political and economic stability. Events like elections, policy changes, or economic crises can lead to volatility in the exchange rate. As of today, 1 United States dollar equals around 83 Indian rupees. Thank you for joining us on this deep dive into currency valuation. If you found this video helpful, please like, share, and subscribe to MONEYMORPH for more insightful content. See you in the next video.